4, 3, 2, 1. Thunderbirds are go. Welcome to the Private Equity Funcast. I am Ryan Milligan, and I am joined today by a couple members of the team at OpenBrand. Some of these folks are familiar to you. I have Greg Munves, CEO of OpenBrand, and I also have Ryan McLaughlin, Chief Economist at OpenBrand, and a pooch. But welcome, Greg. Welcome, Ralph. And Greg, why don't we throw it back to you? You're familiar to this podcast. But if you could do a quick overview of your background, and I'll have Ralph do that as well.
Sure. Thanks, Ryan. And as you can see, this will be my first recording while I'm dog sitting. So it's great to be here. I'm the CEO of OpenBrand. Before OpenBrand, I was the CEO of a company called 1010 Data. I pretty much spent my entire career helping retailers, brands, and Wall Street firms get signal from data. 1010 Data was essentially one of the first big data analytics platforms delivered through the web as a service before software as a service was a really big thing and before people were using the term big data. And so when the opportunity came to work with Ryan and create OpenBrand, it was a really natural fit. And we're really excited to be here today. This is sort of the next evolution in OpenBrand's future as we start to leverage our data to provide the market with really accurate, dependable insights from massive amounts of real-time pricing data that we collect. And so my entire career, I felt like the government has been too slow to collect data, too infrequent, and many of the techniques they've used have been a little bit behind the times. And so at OpenBrand, we're collecting pricing information on a daily and weekly basis from around 200,000 products. So it occurred to Ralph and I that we would be able to use that data to help the market really get a good sense of what's happening with pricing. And certainly of the moment, everyone's concerned about inflation. And we think that our data is in a really good spot to help the market understand in near real time, certainly much more frequently and much more earlier than the Bureau of Labor Statistics can report it, what's happening with inflation. And so we've developed the OpenBrand Consumer Price Index for durable and personal goods, which is a proprietary inflation measure designed to track real-world price changes in durable goods and personal care products. It provides really granular, data-driven alternatives to the Bureau of Labor Statistics, CPI, leveraging our very vast, very real-time pricing data sets. And what you'll see, and Ralph will take you through the details, is that there's a extremely high correlation between our consumer price index and the Bureau of Labor Statistics. And we're able to prove that out at both an aggregate level and as well at different category and industry breakouts.
I'm Ralph McLaughlin. I'm Chief Economist at OpenBrand. Thanks for that primer, Greg. Just a brief background on myself. I'd like to consider myself a recovering academic. I got my started as a full-time professor at a few different universities. I got my start in Australia, actually, and then came back home to the San Francisco Bay Area. And I've been a housing market guy for most of my career. I started researching and teaching housing economics and real estate development in the early aughts. I left the academy in 2014. Actually, went to a real estate website called Trulia, which was bought by Zillow, and I was there for about 4 years and served as the chief economist of the Trulia brand within Zillow. I then went on to a few other real estate firms, probably the biggest real estate data vendor out there called CoreLogic, and then to a startup called House, where we dealt with investments in home equity. But throughout all of that, my passion has been data, and more data, digging into the data, and very similar to Greg, was trying to find signal from noise. Big data can be your best friend, but it can also be your worst enemy if you're not getting the right signals. There could be a lot of red herrings out there. So. When I had the opportunity to learn about this role and potentially join this company, it felt very familiar, even though it's not the housing space. It is the durable space. Housing is a durable, just like appliances, fridges and freezers, and so to learn that we had such a wealth, that OpenBrand has such a wealth of data on pricing and promotion and placement, that it just felt like there could be 3 or 4 or 5 lifetimes worth of work, and that was probably the biggest attraction here, is that I could come to OpenBrand and really just dive into as many different projects as the industry desires, or as intellectually curious person could get into. So that was the primer for all of this. That's a bit of my background, and as Greg said, we have prices on over 200,000 products. That's about double the density that the CPI has, and so that allows us to build credibility and authority in the space. One thing I learned early in my career, that it's not just enough to sell data, especially in the private sector. You also need to know how to use it, and you need to be an authority in what the data can tell you, i.e., what is the good signal, and then what maybe you should ignore or not listen to. And so one of the big goals here, both in the monthly and weekly CPI, was to draw out those signals and prove that we are credible, and that we can follow the CPI. But also, as you'll see later, we're very good at forecasting where prices are going to go, and so that's a brief primer about my background, where I've been, what I'm currently up to, and what are the things that we're working on at OpenBrand.
Well, thanks for that. You know what? Why don't we hop into the data here in a second? We'll pull up the slides, and Ralph, you can start walking us through this.
Sure. So the CPI-DPG, as we're calling it, or the Consumer Price Index, durable and personal goods, is a consumer price index that is proprietary to OpenBrand. We have taken heavy influence and cues from the BLS, from the Bureau of Labor Statistics Consumer Price Index, but we don't follow it exactly, and there's some reasons why we don't follow it exactly. But at a very high level, we are creating a singular index that we release not just on a monthly basis, but we release on a weekly basis, because we feel like there is a need in the market for more real-time information. And in fact, subscribers can not only get weekly data, but they can also get daily data on pricing. So we think that's a big addition to the space of consumer price indices. We would essentially be the third major price indice out there. The two that you may have already heard of, one I mentioned, the Bureau of Labor Statistics CPI, and then there is the PCE. Those are the two government-produced consumer price indices, and then we are a third private indice. And what's I think important, not just that we provide very temporally granular data that we can produce not just on a monthly but also on a weekly and daily basis for subscribers, but it also provides a third data point in the marketplace when someone is trying to figure out where prices are heading. Sometimes the BLS CPI and the PCE move in the same direction. They are highly correlated, but they're not identical. And so if you have a third point of reference out there, it allows you to triangulate and figure out which directions prices are actually moving. And not to use too many aviation analogies, I'm a pilot and aviator, but in instrument training, we're learned to look at different instruments, and sometimes instruments may be off or not accurate, and we learn to use other instruments to triangulate what's actually happening. In case maybe there is a blip or a false reading in one of our other instruments, we can rely on a few others. And so you can think of the pricing marketplace out there. We provide that third frame of reference. Now, we do take some departures, like I mentioned, from the BLS CPI, in that we have very, very dense pricing. So the categories and groups that we cover, we don't really have to worry about products coming in and out of a price basket. For example, if a major fridge drops out of the BLS price basket, they will substitute it with another fridge, and they will have to do what's called a hedonic adjustment, try to control for what's different about that fridge over time to try to calculate what actually happened, apples to apples with prices. Well, if you have data on nearly every fridge in the market, and a fridge drops out, if you're trying to measure apples to apples changes over time, well, you can just let it drop out and rely on the price changes of all the other hundreds of fridges in the marketplace. So we don't need to really rely on hedonic adjustment. And another is weighting.
Is that a classic example of sort of reducing the need for statistical gymnastics when you just work with big data or all the data? In other words, the entire universe of information.
Yeah, that's a great example. A lot of these statistical gymnastics, which you will hedonic adjustments, are very well suited for instances in which maybe you don't have complete data on the market, or maybe you're only producing prices on a monthly or quarterly basis. If you're doing things on a weekly or daily basis, and you have all the data out there, there's no reason you're exactly right. There's no reason to do those gymnastics. In a lot of instances, sometimes it's better to be simpler in your approach and your design of the actual vehicle. Than to be overly complex. You can think sometimes, it's great to have the complexity of a German-made automobile, but there's a lot of things that potentially break down. And sometimes you want the simplicity of maybe an American-made automobile for whatever your purposes are. So in that case, if you have, all of the power or all of the prices, you can be a little bit more simple in how you do this. And another feature to your point is also weighting. We make a departure in how we weight our price indices. In that we don't weight by how much is being purchased in the marketplace. Not that there's anything wrong with that, but we weight on how long a product has been in the marketplace. So our measure is not going to be influenced by new products that come on the market that maybe have vastly different characteristics that potentially can disrupt that CPI measure. We're going to weight products that have been on the market a longer time. We're going to weight that more in the index than products that have been on the market a shorter time, because we think that is a better measure of price stability. And at the end of the day, consumer price indices are all about measuring price stability in the market. And so we are going to weight heavily prices or of products that are on the market longer than shorter. Again, it's not right or wrong, it's just different, and we think that's a valuable signal to the marketplace. So if we think about how our consumer price index is structured, as I mentioned before, we have the broad level. You think about an onion. We have the whole onion, which is the OpenBrand Consumer Price Index, durable and personal goods. That's the whole onion. And then as you cut open the onion and get into the different layers, we have 5 different groups. And those groups are appliances, communication, home improvement, personal care, and recreation. And these are groups that the BLS actually uses. So as much as possible, we map our categories, and we have 146 of them. We can give you a glimpse of all 146 and growing, by the way. We're it was 146 last month. Next month it might be 150 or 200. So we're growing, but we map them as closely as possible to the BLS, so that we can get an apples to apples, or in this case, maybe an onion to onion comparison of price changes and price growth. So in a nutshell, that is our CPI-DPG and the structure of it. And in addition to looking at monthly, weekly, and even daily changes in the OpenBrand Consumer Price Index, we also now just released a forecast suite, where we are forecasting where price changes, where we think price changes are headed, both for durable and personal goods, but also these individual categories, based on expectations of macroeconomic conditions and policy changes, which are very important now in the political landscape that we're seeing changes, sometimes on a day-to-day basis. And in addition to the forecast, we offer scenario-based forecasting. So we have a baseline, and we do release that. But we also have the ability to do scenario-based forecasting. So maybe you don't necessarily believe what Open Brand believes as far as where we think things are headed. That's totally okay. You tell us, are you more or less pessimistic? And we can actually tailor a forecast of price changes based on how you think the world is going to be. So you don't just have to rely on our view or my view as an economist or where I think things are headed. We can actually tailor that forecast to your particular brand, to your particular product marketplace, or your particular view of the future. One of the important things that we've done in the creation of both the Open Brand CPI as well as the Open Brand CPI forecast is proofing. And we've done two types of proofing using one metric, and that one metric is called a MAPE, or mean absolute percentage error. It basically is a measure of how far off you were on average in an absolute basis. In other words, if I was down, if my estimate was 2% low one month and 2% high the next month, my mean absolute percentage error would be 2, because on average I was 2 percentage points away. And so we've calculated a monthly MAPE for our CPI, and because we're generating the Open Brand Consumer Price Index (DPG) using our own data and our own methods, it is blind to how the BLS is calculated. So we can actually do this on a month to month basis, going back, as far back as our data go, and we've done that, and we've basically come up with a MAPE of 4.6%. That means on average, our CPI was 4.6% off from the BLS CPI. And in any forecasting or any estimate, anything below 5 usually is you're doing pretty good. And there are actually reasons why we might expect our MAPE to be greater than 0 in the perfect world. And that's because we have been very selective in what we are actually including in the Open Brand CPI. It's not the exact same basket as what's in the BLS CPI. And in fact, if you actually look at what we don't cover, we don't have automobiles. Maybe someday we will, but we don't have automobiles. If you actually include the BLS measure of prices in automobiles, and you overlay that on our estimate of our Open Brand CPI, it actually explains a lot of the difference, right? So if we were to have automobiles and were to include it purposely, our Open Brand CPI would very closely mimic the BLS CPI. So the reasons we're off in a lot of cases is because our baskets are purposely slightly different than the CPI. And then for our forecast, which I'll get into later, we actually do a blind forecast proofing. And what we'll show you is I went in and did an estimate for every month of prices in 2024, as if we were in December of 2023, using only data that would have been available at the end of 2023, forecasted through 2024, and then compared it to what actually happened. And we show you the MAPE for those forecasts as well. So, here's an example here where we show how our Open Brand CPI is parallel to BLS CPI, and we're pretty darn close, especially if you take into account the fact that we don't have automobiles. And then in some instances, we can get even more accurate. So, for example, if you look at the Open Brand CPI-DPG for other categories, like, for example, if you look at the estimate for personal care products, if we look at, in this instance, we are very closely aligned with the CPI. And that's because our basket of goods in the personal care group is very, very closely aligned to the basket of goods that the BLS uses. So in this case, our monthly mean absolute percentage error was just 1.6%. And you might look at this and be like, well, why do those lines diverge? Why aren't they? Well, you got to look at the axis here. We're trying to show in a very fine detail in 1 month we were off. But the x-axis here, if you would expand from zero, we're we're basically right on that line.
Right.
The other thing, just one second. The other thing I'll mention is that if you go to the prior slide, not only are we releasing the Open Brand CPI personal care, in different groups, but we're also releasing our estimates of discounts, both the frequency of discounts and how often discounts are in the marketplace and magnitude. And those actually give you some indicators as to why prices are changing. And you don't necessarily get that from other measures like the BLS or the CPI or the PCE, right? So we can tell you, oh, hey, prices changed this much because retailers and manufacturers change their discount frequency, how often they discount, or their magnitude. So in this light blue is the frequency. That's how often you see in this case for in January of this year, we saw a little over 20% of products in the durable and personal goods space was discounted, with a typical magnitude of discount also of about 20%.
Maybe we take a breath here. Maybe we take a breath here, and this would be, since we got the data in front of us, Greg and Ralph, whoever wants to take it.
Sure.
If I'm at a manufacturer or retailer, and I have this at my disposal, what are a couple of use cases that come to mind for somebody to make a corrective action or a different decision with this data in front of them?
I think the first thing is, if you're trying to figure out what your pricing strategy is, this can be like a starting point for that. Mm-hmm. So as you dig in much deeper and look at all of the competitor by competitor, brand by brand information, product by product, you have sort of like that reasonability test to say, all right, well, how much should I expect to see at what levels, so that as you dig in and then you build those strategies for your portfolio of brands and products, you can make sure that you're not like over discounting or under discounting, and either giving away margin or losing share as a result.
And this could be especially valuable, on not just a monthly basis, but on a weekly or daily basis. And if you're not, say, an industry leader when it comes to setting or changing prices, but maybe you're just below that, knowing exactly when your competition is changing their prices and how much can help you be more competitive in the marketplace.
Right. And then obviously, if you're building a financial model because you're an investor, right, you can use this data to get to sort of front run the BLS and get a sense for both at the aggregate level and then at the breakout level, what's likely to happen with prices and promotions and discounting, essentially, so that your models can be more accurate about the future earnings of the companies that you're invested in or looking to invest in.
I think what's equally exciting, if you go and look at our weekly MAPE, which is on one of these slides here, our weekly MAPE in this instance is even more accurate than our monthly MAPE, at least for the durable and personal goods. So you don't have to wait every month for the release of the CPI from the BLS or the PCE. You can make decisions. You can make very timely decisions, and in a marketplace that's moving as fast as today's digital marketplaces, the monthly data just doesn't cut it anymore.
Makes sense.
So this is an example here of what we're showing in our March release, which is February data of our CPI. Again, we have these metrics down on a weekly and sometimes daily basis, but this is our monthly release, which is free to the public. And the takeaway here is that we may be in the calm before the storm. And what I mean by that is we are in a economic scenario where all of the reasons why prices boomed during the pandemic like all those reasons basically are, have gone away, right? So we're seeing inflation as a result of those influences come down, and that's very clearly showing up not just in our data, but also the BLS CPI and PCE. But we're also in a scenario where we have a new administration who is implementing tariffs and other policies that potentially could reignite inflation. Whether it's on a temporary long-term basis is a different scenario. So what we're seeing here is that our measure has shown just a very small increase on a month-over-month basis. And in fact, if you actually look at Cleveland Now does also a real-time measure of inflation, and theirs is basically flat. Theirs went from about 0.2% last month down to now 0%, and ours has essentially gone the same trajectory ahead of their release. And of course, we've seen price changes much higher for goods that tend to turn over more. So personal care, recreation, home improvement, goods in those spaces that turn over more have seen more price increases. And that could be because some of the inventory has turned over faster. And when inventory turns over faster, if it's subject to things like tariff, well, price increases would show up sooner versus goods that don't turn over as much. Things like phones, I buy a phone, maybe once every 3 or 4 years, or I buy a fridge. I don't know, the last time I bought my fridge, maybe 7 or 8 years ago, things that don't turn over as much. The fridge I buy today, if I were to go to the store, probably has been in there for a while pre-tariff. So, we may see some lags before, the impacts of tariffs show up. But essentially, that's where we're at from a macroeconomic perspective. Again, we're in a very fluid situation. Things change on a daily and weekly basis. We're monitoring it. We put out our forecasts and our forecast scenarios on a monthly basis. So as things change, we can incorporate them, not just into our weekly and monthly CPI, but also into our CPI forecast.
Yeah, I mean, and as you try to make your guess about what's going to happen with tariffs and the effects on prices, the potential deflationary pressures associated with the government spending less money in the future, and the productivity boosts that the world is now experiencing from AI. This data, this granularity, and this frequency is now market leading for anyone who needs to understand what's happening with inflation.
Yeah, that's a great point, Greg. There are a lot of other things to consider when it comes to whether or not we would see, the face value of tariffs actually show up in the products that we buy. There are a lot of reasons to think that actually might not happen. And in some cases, we might not see any increases. And so we can sort of think about these different scenarios. The first thing I'll mention is that tariffs overwhelmingly are on wholesale products. And because resellers of wholesale products actually are trying to make some money, there is a margin there. And so what they actually sell it for, even if they were to incorporate 100% of that tariff, it doesn't mean that the retail prices are going to go up by the face value of that tariff, because there is a margin there, right? And so in cases where you have low margins, yeah, you might get something that's close to the face value of the tariff, but maybe not exactly. And then in places where there are high margins, resellers may decide just to take the whole hit, especially if they think the outcome is going to be short-lived. And then the other thing I'll mention on that as well is that markets adjust, and so we have seen currency markets, not completely, but in some cases, start to absorb some of these changes. So, if you look at the exchange rate, say the Canadian dollar, it has fluctuated, but we have seen it come down since markets started pricing in a Trump victory at September, October of last year, and so with the U.S. dollar buying more, going further in the Canadian market, that offsets some of that. So that's a very good point, Greg. Just because there could be a price storm ahead doesn't necessarily mean that we're going to see the full value of those tariffs manifest themselves into prices, then in some cases it might be negligible, hard to pick up.
And to your previous point, right, with respect to wholesalers and then potentially retailers eating some of the cost from the tariffs and not passing it through, I think that's just builds the case for leveraging, more granular, more frequent data from OpenBrand, so that and especially looking at the discounts and the discount frequency, so that you can build more conviction around how a potential retailer or brand is going to perform in the changing environment.
Yeah, absolutely. We can see whether or not someone who is manufacturing a lot of their products in China has actually decided to change their prices at all,
Mm-hmm.
and that as especially as maybe a retailer, if you're mid-size or mom and pop, that's value. That's extremely valuable information. It means you don't have to go down the street and walk into a big box store and see what folks are doing.
Just one, since this is the private equity Funcast, where it's really interesting to listen to you talk. I mean, you've got great perspectives for folks that are more in the trenches, retailers, wholesalers, are kind of living this day to day, making decisions, trying to figure out where they're at in their near term P&L. As a private equity investor, it's interesting. We're obviously we're illiquid and we're longer term focused. I think where we kind of stare at this is on two fronts. One, do we have we happen to be software investors? Do we have end markets who are going to be kind of in the thick of it, thinking this through, what the effect it might have on its business, that might have them pause investment decisions or think something through more? They might be going through some pain. They might change their decision making, that type of thing. And then longer term, it's kind of that, how long do they last? And depending on the level of capital investment, like, will this actually change supply chain behavior? Now, that's not something that can be done overnight, but will factories start popping up more near shore or not, and that type of thing? And just because we need to think 5 to 10 years out, it is hard to turn these ships quickly, but if it sustains, there will be, with these negative incentives, the prior administration was kind of trying to do with positive incentives. Now it's a different approach, kind of the same goal at the end of the day. It's just, what are you, is it a carrot or a stick? And where will that affect our end markets that our software solutions and things like that serve? So definitely interesting to watch the data over time and see if things look like they're going to start shifting around, or if it's going to be a little more business as usual.
Yeah, and we put together these breakouts because they'd map really nicely to the BLS breakout, so that we could kind of demonstrate the correlation and build authority. But the fact of the matter is, as Ralph mentioned in the beginning, we're currently covering many more categories than this. And so over time, we'll start releasing more data, more indices for more categories, some of which may map really nicely to the BLS. But our hope is that for our customers, that they'll look at the rest of our data and say, well, look at all the correlation they have along these categories. We believe them when they say these other categories that we're very focused on are predictive, even though there is no BLS breakout to compare it to.
Right. Makes sense.
Yeah, and to your point, Ryan, we've talked a lot about sort of the short run, what all these data mean for retailers and those that are maybe setting short-term price strategy, and that's exactly why we created the CPI forecast, to give that longer run view of where we think things are going to go. And if you look at our forecast model accuracy, and this is actually forecasting the BLS CPI, so we're not drinking our own Kool-Aid here and trying to forecast our own CPI, which would be, a little incestuous, I guess, for lack of a better word. But we're actually trying to forecast what the BLS is reporting, and doing this blind forecast for 2024. The model that we've built, which is very accurate, one of the, I think the most accurate model that I've ever developed or worked on, is at the worst. Yeah, at the worst is 4%. At our best, especially in the home improvement, communication, and recreation space, we're under 2% error. Which is pretty mind blowing. I mean, anyone who's been involved in forecasting, even 10 or 15 years ago, getting anything below 2 or 3 consistently, seemed to be a moonshot. So we're doing very, very well. And more important than this, as I mentioned before, for a private equity investor, if you have a different viewpoint of the world, we can tailor our forecast, and we can go back and actually tell you what that accuracy would have been. Maybe you think you can be more accurate, and we can run a different scenario, and not only give you a forecast, say for the next year to 36 months, but we can show you how accurate it would have been. Yeah, and that's an example here of the home improvement category, home improvement group of the BLS, and then our forecast. We pretty much threaded the needle here when it comes to forecasting what would have happened in 2024. Again, we did this as if we were forecasting in December of 2023, so we weren't using any information or data that wasn't available in 2023. We weren't greasing the wheel. We weren't sort of cheating in our forecast here. And our forecast, which is in the light blue line, pretty much was spot on with the BLS CPI. And so knowing where price changes is occurring, and when and what trajectory it might go, can help folks who are doing long range planning. To your point, Ryan, on PE side, in this case, it does appear that there could be some transitory effects from pricing in the home improvement space, but we don't expect those effects to be persistent and long term, or of great magnitude. And so you, as a private equity investor, can make very informed decisions. Knowing that, again, we're in a very fluid environment and things change, and we update our forecasts on a month-to-month basis, which is all the reason, to make sure you come back and check in with us every month, and we can tell you how things either have changed or stayed the same. But again, it's useful not just to folks that are in the PE space, but those that are trying to forecast revenue. We're now working on rolling out forecasts for actual unit shipments. And our R&D work on that is proving as good as our price forecast, and also those that are interested in policy making. So we've had a lot of this discussion around PE or private sector, but there could be public sector folks that would be interested in this as well, when it comes to not just evaluating what has happened with policy, but also what can we expect with policy, or what additional policies might we want to think about, enacting in the future.
So maybe we segue there, Greg. We can talk a little more about the use cases that you saw for this. We touched on it a little bit, but if Ralph is, we've got good data here. Our MAPE is pretty darn good. So we've got some ability to see the future. Who are we calling out to? Who should be thinking about this, using this, talking to us about how to incorporate this into their people that you'd want us and our employees to be talking to the most?
Yeah, so I think there's different buckets of people who can kind of make hay from this data. First off, I think anyone who is trying to optimally price their products in the market, this data and the data that really underlies this, the really granular, daily or same day pricing information for the products that we cover, is a must have. We have many customers using that now. So if you're not, you're essentially just working off old data. And that's really for retailers and then their manufacturing partners. And then the other are, the investor community. The first part of my career, we spent helping kind of launch and unlock the alternative data market, and helped investors use lots of interesting new to world data sets that are no longer new to world, to kind of get alpha. And so this is an opportunity for them to get a sense of, price inflation, but way before the market reports it. And so to the extent that their, macro models or any models for that matter, take into account inflation, which many do, this is a way they can get access to a monthly CPI released weekly, way before, up to 3 weeks before the BLS will report its monthly number. And we can do that both at the aggregate level and at the breakout level. And then, as Ralph alluded to before, we can also create custom CPIs for specific baskets of products as well, whether they're a category or not. Of course, those will not map to any BLS category in that case, but to the extent that we've proven to you that our data is both correlated and predictive, we can provide, granular custom breakouts for investors or anyone else who wants to get early insight into what's happening with inflation for those products.
Makes sense.
Yeah,
I mean, and then there's a lot more, right, Ryan? So like that's just on the kind of consumer price side of things. Right. We've got all this granular data for that, but we also have very detailed product information. So we're not talking about just brands here. We've got all of the core and additional specs that go with each of the products. We've got localized inventory data that can be matched up with this at the product level across different retail channels. We can see how people are pricing things and how that correlates to how they are promoting those items and advertising those items. And then we also have all of our market measurement data so that we can help companies understand how all of these price changes end up reflecting in consumer purchase behavior and ultimately, market share at the product level.
Yeah, why don't we finish up talking about where this is going? Because this is, it's been fun to listen to this discussion. We've come a long way in a short period of time. I think Greg, we've been working 18 months now, and I think, Ralph, you're still under 90 days. And we just went through some pretty rich, accurate, interesting new data. So I can only imagine, kind of where this is going to in the future. But you want to talk a little bit about like the progression of this or some big ideas that you think kind of come from this down the road? And then let's also make sure we talk about what categories we have or will have today, and also if people want to get access to this information, where they can get in touch with us to find it.
Yeah, I mean, I'll let Ralph get into some of the details, but I would just say at a high level, like this is actually just the beginning. So we're already talking about other data sets that we can create and leverage to make this even more accurate. For example, OpenBrand runs the largest long-running consumer tracking survey, where we're asking thousands of consumers every single day lots of questions about their purchase behavior. And so we'll be adding questions into our survey to help reflect the consumer sentiment around what's going on with prices as well. And we hope that will help make our forecasts even more accurate over time.
Yeah, so that's a great point. It's one thing that's also often missing from measures, missing from other measures of, consumer prices, is actually how are consumers feeling. In some regard, the whole trick in the game is, well, do you trust what people say, or do you trust what people do? And actually, in the best case scenario, you're measuring both. Because both do have predictive power. So, since we run a daily survey, we can start asking people, what they say, how they feel. We can actually test that to see how much they say is correlated with what they do, pull out that signal, and then put it right in our CPI. And there's no one else that's doing that in this space. And some other the future of other predictive analytics that we're working on, briefly mentioned before, we're going to forecast shipments, and we have some R&D work that's pretty close to production in that space, where we can predict actual unit shipments, and then also retail sales. One of the things that the federal government releases every month is sales of things like electronics and appliances in retail dollars. And our forecast model that we're running here is also proving to be in our R&D pretty accurate in actually forecasting volume sales at the retail level. And then the last thing that's in our pocket, but I think it's not too far out, is actually coming up with measures of market influence. So since we have daily data, we can see if someone changes their prices, what is the impact on the broader market of price changes? Are they influencers? If someone who changes their price influences the market, and we see a lot of changes, say in the next 1, 2, 3 weeks, we can have a measure of that, right? We can see how much influence a particular retailer or manufacturer has when it comes to pricing. And then we can use that to actually weight price changes in the market. If a big influencer comes in and changes their price, that's something we all should pay attention to, right? But if a small influencer, someone with basically no market influence, changes their price, we can downweight that change in the CPI. And so not every price change in the market is equal because of that market influence, that market dominance. And we're already making some both theoretical but also some very empirical strides in actually bringing that measure to market.
Well, I think that was a really good overview and really exciting stuff. Anything else you want to speak to in terms of categories covered or?
No, I mean, these are the categories we're focused on right now, but
where should they get it?
Yeah, I mean, so these are the categories we're covering right now, but like Ralph mentioned, we are adding new categories every single month. So this list will grow, and our ability to break out into more granular detail will continue to grow as well. And these reports can all be found on our website at www.openbrand.com.
Great.
Thanks, Ryan.
Thank you, Ryan.
Thanks for joining us today. Thanks for going through all this. Very exciting, and appreciate it.
Absolutely.
From the heart of Chicago to all over the globe, a couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat. It's the Private Equity Funcast. That equity is private. If PE excites you, let it show and do not hide it. Devin and Jim.